Folks, is Warren Buffett buying these two stocks? Well, let's get into it. Warren Buffett needs no introduction. He's probably the most famous long-term investor in modern history and one of the top 10 richest men on earth over the past several decades, actually, now that I think about it. He's been up there for a while. Now, over the years, I've studied Buffett and his investment strategies in great detail. And one of the most important takeaways I got from Mr. Buffett was simplicity. That's right. Don't overcomplicate things. Aside from picking stocks to do well through good times and bad times, one of the unspoken factors in Buffett's selection criteria is few moving parts. Think about the most massive investments he makes. The crux of his business model can usually be explained in just a few words. Coca-Cola sells flavored gas water. Geico provides insurance in case of loss. Airlines fly people from point A to point B. While I may be oversimplifying it just a bit, the fact remains Warren Buffett doesn't invest in business ideas that are overly complicated and have too many moving parts. If you look at it mathematically, the more moving parts something has, the higher the odds that something can go wrong. The less moving parts, the less things can go wrong. It's just that simple. And higher the odds that things will continue working the same way over and over and over again. While you may be thinking that this is too basic and too simple, I dare you to find me one business that Warren Buffett ever got into that can't be explained in one sentence. Now, once Buffett gets past the overall business model, he then seeks to identify value. These are the questions he's likely to ask. How has the company been performing? What is the return on equity? How much debt does the company have? He looked at the ratio of debt to equity. How much profit margin? That's one of the best indications that business is growing, is when profit margin increases. This tells Buffett that management is doing an amazing job at maintaining costs. How unique are the company's products? The less unique the products or services provided, the less Buffett will be interested. He's looking for a competitive advantage over other companies, a leader in its field, something that other companies can't offer. Finally, how much discounts are shares trading in comparison to fair value? Since Buffett likes companies that are undervalued in comparison to their intrinsic value, he will want to look at the book value of the company to determine how much the shares are really worth in case the investment turns south, just like any other investor buying any other business. Small business. He just does it on a large scale. Now that we've gone over the general principles of Buffett's investment style, let's take a look at a few stocks that fit his criteria. Now, before I name ticker symbols, and for these stocks, keep in mind, regardless of whether Buffett himself buys these shares, the framework he uses for his investments is roughly similar to 30% of large hedge funds, which follow his accumulation and distribution models over the years. These funds are called value funds, and they look at the same criteria that Buffett does when buying and selling stocks. So there's a good chance these stocks are going to see strong accumulation over the next few months as a result of that. The first stock on my list is Moody's Corporation, ticker symbol MCO. Moody's provides credit ratings, research, and risk for investors, banks, and different government agencies. Think of it as a credit score, but not for individuals, but for public companies. Moody's actually plays a vital role in the process because without a rating agency's ranking, the company can't issue bonds and raise capital. That's huge. The company has very little overhead, which means high profit margins. In the first quarter of the year, the company had 60.5% operating profit margins, which equates to about $1.3 billion in revenue. What I truly like about Moody's is a scenario where a recession hits the economy. When that occurs, investors and traders rely on data and risk analysis, which increases the need for companies like Moody's. The stock has 4 positive earnings surprises each of the last 4 quarters, which should increase institutional accumulation over the next few quarters. I believe with the economy uncertainty on the way, there's a good chance price will remain near all-time highs, which is what we're seeing right now with Moody's. And again, the ticker symbol is MCO. The other stock I'm seeing Buffett targeting is Restoration Hardware. He actually already owns a bunch of it. Ticker symbol is RH. It's a luxury brand in the home furnishings marketplace. RH operates 68 retail galleries, including 40 legacy galleries, 22 design galleries, 4 baby and child galleries, and 2 modern galleries through the United States and Canada. It also operates 15 waterworks showrooms throughout the United States and the UK. The company has been growing the last 3 years substantially. 3-year return is it's at 242.76%. The cash equivalent is at 47.7 million as of February 1st, compared to 5.8 million a year ago. Can you imagine that? That's good. Adjusted earnings are $11.66 per share, $11.66 per share, increasing 49.5% from $7.80 a year ago. The company is smoking hot. While many analysts believe the stock price would hit hard in light of the COVID-19 stay-at-home restrictions, price has been increasing substantially, demonstrating extremely aggressive institutional accumulation in recent months. Buffett has been increasing his exposure in RH stock by over 40% in third quarter of 2019, and I'm expecting more accumulation in the next few quarters, especially in light of how well the stock is bouncing back from prices from a year earlier. I like RH, and I believe we will see strong accumulation and increased accumulation from Buffett himself. Hope that helps. Folks, listen and listen good. There's going to be a surge, and I mean a surge, of post-quarantine spending as governments slowly reopen. And we're likely to see some massive gains and spikes in specific stocks. That's right, you can't miss this buy. In fact, I've already predicted a 66.1% return. And luckily for you, I've got a brand new pick that could earn you an easy $3,680 in just 10 trading sessions. That's right, 10. Click the link below to see how you can cash in on my big post-pandemic moneymaker. Do it now.